Welcome to Momentum Monday. Today is February 26th, 2023. Howard, you're looking like you just got back from hunting.
I'm hunting millennials. Listen, does anybody really know what day it is?
Meaning what?
Maybe AI took over and this isn't even us talking.
Maybe it's too early for that.
Oh my goodness. Hey, you know what show you should watch? Gomorrah. Have you watched that on HBO? Do you even,
No.
you have no time. You're out volleyballing and swing trade.
I don't have HBO right now, but I'll check it out.
So how's life?
That's pretty good.
It's probably the worst winter I can remember for Phoenix. What about San Diego? Maybe the worst ever.
The same. Yeah. It's okay. Things will get better.
All right. Let us bring us up to date.
Yeah. I mean, as we all know, we had a pretty strong start of the year. Like in January, almost everything went up. And the worst hit stocks from last year were the best performing stocks this year, like Tesla and Align and Generac, even Nvidia. And then many of the softwares. The semiconductor index thing went up almost 20% just in January. But at some point, early February, interest rates started to creep up again. They've been perking up for the entire month of February, and they reached a point at which equities just could not sustain their rally, and they've been pulling back for most of February. Definitely, a lot of equities have had at least 10-20% pullback in February. As we can see here, the S&P 500 just tested its 200-day moving average on Friday. I think psychologically this is an important level for the bulls to kind of step up here. Otherwise, we're probably looking at a best case scenario range-bound action until some major catalyst shows up. And it's the same with the Qs. Obviously, they're much more dependent on interest rates, and interest rates have been rising. I mean, the 10-year yield is like almost 4%.
Yeah, I mean, I think that the 2-year yield, Ivan, hit a new kind of high. I think it was 20 basis points a year ago. It's 5%.
Yeah,
right
I mean,
now. So
inverted yield curve. Yeah,
inverted yield curve, not a good sign. Continues on forever, it seems. People say people are bearish, but like I was looking for a chart. It's the most over-owned. I'm just looking for some charts I was looking at, but it's kind of over-owned the market. I saw a few charts that I was going to share, but you have to trust my word for it. People own more stocks than kind of ever. Millennials are record high credit right now.
and so are the governments. Governments are record high credit too.
Yeah.
But
so millennials have the government. The old people like me are paid down debt to record levels. So there's money out there. It's just the young people are saddled with high stock prices. If you went into tech, it's kind of a winter. Machines are common for your job in tech. And it's expensive to own a freaking home. So you're relying on your parents. Kind of a bummer to be a millennial. And the home builders have pulled back. I think we're a slave to rates here. Like, let's be honest. So you got to look for relative strength. Like, you want to see which stocks hold up the best here. So,
well, currently, you kind of have financials and energy holding a little bit better than the rest, but those could do better only if we assume that there's not going to be a recession.
Correct.
And the inverted yield curve kind of means that. So someone is wrong here.
So they could crash and play catch up financials, and it's fine to look at relative strength, but remember, these aren't growth companies. So energy and financial will catch up to the downside quickly if the recession happens. All the language switched to soft landing, and we've seen that's caused a sell-off here when the soft landing, interest rates are going to disrupt any soft landing. Anecdotally, I ride kind of the same routes, my safe routes through Scottsdale, Paradise Valley, Phoenix, and there's more homes for sale. And this was a tight market for a while. And now there's a lot of homes creeping onto the market. And I ride like 30 miles through 3 cities here. So it was tight. And I used to comment for a year how, there weren't homes on the market. Now you're starting to see them surface in Phoenix, Scottsdale, Paradise Valley. So that's anecdotal. But still, for my eyes, we're seeing the effects of rising rates. Right? First, you get the crash in transactions, but then people realize they want to sell, and then people start lowering their prices. So we'll see. Listen, a lot of consumer stocks, Nike, Lulu, kind of rallied, but now they've stalled. Starbucks was looking good. It stalled. Thanks for pulling these up. Starbucks was looking like it was trying to rally. It stalled.
It was kind of a China story, really, because they have so many locations in China. China reopening, but then anything related to China really got hit in February.
Well, if we haven't learned anything right now, why are you going to trust? Like, if China's your story, right? Like that story's, done with Wuhan and COVID and Z. So the small cap story was interesting. Let's, the mid cap story was interesting because they're not as reliant on China as the growth companies, and they've held up. So there's no reason to panic. It's just we're not in a raging bull market. And I had Helene on my podcast. She's a great technical analyst for 30 years, first Goldman Sachs, female technical analyst. And she, would expect ranges. It's a hell of a good rally in some of these growth stocks. If you didn't sell into this rally, it kind of hurts. I mean, Tesla looks really heavy still. Like you're rallying into that 200-day declining average, and if it busts through with conviction, maybe we get a term, but like it's heavy. Like,
it's more likely to go sideways for a little bit in a range.
It would be bullish if it went sideways, right? If it didn't go back and retest, those panics at some level. So, I think we're kind of wait and see here. I don't have any great ideas. The more the stuff goes sideways and the more interest rates stay up here, the more that energy and financials could catch up to the downside. That's my only big idea.
Exactly. I mean, we can talk about some individual setups, but then keep in mind that if interest rates continue to go up, they're not going to work. I mean, for example,
I don't have many. I don't have
like Melly. They had a great earnings report on Friday, huge earnings surprise, big acceleration in growth.
Kind of daily okay, but if you look at the weekly and monthly, it's hell.
I know it's still stuck below some resistance. It's just working on a new base. And then, there are quite a few of them, but as we said, right now everything depends on interest rates. I mean, the one kind of story this earnings season so far has been that most companies have reported lackluster earnings, meaning they either missed estimates or guided down. And then despite of that, the majority of them went up, especially in January, early February. And we're talking like Apple and Google and Amazon and Microsoft, even NVIDIA, which kind of gapped up on earnings. I mean, they missed earnings, like 3 quarters in a row, negative earnings growth. Now we have negative sales growth. They just mentioned AI, that there's a big opportunity down the road in AI.
No, they will benefit from AI, but it's still trading at, 50
it's a major company ready to play it. But then if they lose that low from last week, it can easily close the gap, because so many stocks kind of gap up for a day or two after earnings, and they gave it all back. So don't get that excited. I mean, look at like Roblox, and
that was a nice little break,
really, and so many of them, they had like a gap for a day and then they give it up.
Yeah,
that's why I'm saying that in a rising interest rate environment, it doesn't really matter. Like in a hot bull market, those gaps, they follow through. Like the stocks will
The
continue.
good news is if these companies truly can turn it around, these gap and gives will create good bases and create.
Yeah, absolutely. I mean, for a swing trader,
It may take
if you have
6
a
more
bounce,
months to a year or even 18 months, but you need lower rates. But all this backfilling and scaring of people, these breakouts and everybody rushing to speculate only to give it back will truly build better basis for healthy gains. But you got to know your companies right now. That's a big give back on trade desk. So it's anything.
all of them look the same, Howard. I just showed 3-4 examples, but all of them look the same.
Yeah, Confluent, Cloudflare, CFLT was one that I've been eyeing, and it ran up quickly, came back.
Yeah, I mean, so many of them, they just kind of look the same.
Yeah.
And I know a lot of people have been pointing out, oh, look how strong Europe has been. But then you have to understand that Europe is so much behind with the inflation battle, because over the past year, really, European governments decided to have much bigger deficits, so they kind of subsidize energy costs for households and especially companies. And something like Italy typically runs 30-40 billion deficit every year, and they added another 50, so double that, just so they can help their businesses to stay afloat. So while the ECB has been raising interest rates, at the same time, government has been heavily stimulating, and Europe might have a much longer path to fight with inflation. Obviously, they've been doing like heavy fiscal spending.
They've done relatively well. I talked about with JC. It's just relatively because it's
technically yes, but that's why I'm telling you why. Because they've been basically
and it's industrial based. There's no technology.
They've been printing money, Howard. That's the main reason, not because the economies are doing that great. So
I think this is like a week that there's not much you're going to miss. It's been a terrible February. And this is going to be a battle of attrition. I'm very light equities. It was a nice rally. It was a chance to lighten up some things. You're getting no real strength. The biotech. That's
I mean, pretty rough week, for biotech.
It's starting to like wear on people. You can just see. So Bitcoin's probably held up the best. Bitcoin and Tesla probably held up the best here.
Yeah, Tesla and Nvidia, the two big leaders. Bitcoin definitely up about 50% year to date, and it's a kind of risk asset. So, I mean, as long as those three hold, there is still a chance. But if they start to roll over, and obviously we still have the AI, they kind of building a
but that's just pure speculation.
Pure speculation.
Still very early.
They report earnings this week.
Yeah, but until you still start seeing some clear path in how Microsoft, Google are going to play out. Like Google still sold every day.
Probably the weakest among the tech mega cap. And Amazon is there too. Not looking great.
Yeah. Shopify as well. E-commerce is weak.
Yeah, Shopify.
So
Airbnb also kind of gave up their.
Yeah, because of valuation. Like I said, like my number one thing with Airbnb and Uber, I use Uber Eats now once a week. It's just valuation. It has nothing to do with the company. They're executing great. The product's great. They continue to innovate. Their competitors are falling by the wayside because of, they just don't have the scale that Uber has. And, Uber's just, what is the valuation? It's just,
67.
$70 billion. So, for you to think that this is a $200 billion company, that's a stretch, for a company that may make, 50 cents a share. If you trust the numbers next year, that would be, these are expensive companies.
So you're saying that in an environment of high and rising interest rates, valuation matter a lot more than it used to in the past.
That's what I've been saying forever. We're just going to get compression. And same thing happened after 99, 2000. It's not that these companies aren't great or going to be around. It's just they got to grow into this valuation.
All right.
The early investors got the whole benefit of these, and the public market's just holding the bag right now. So I think it's in a war of attrition. You've got to get in the right mindset, get away from the screens. How are you? You're probably high cash still.
I'm high cash. I'm being more careful, more nimble, especially in the past couple of weeks.
When you see this many companies give back, you can't gap and give back. You just can't get excited.
I mean, very high correlations for sure, probably 95% correlations with almost everything pulled back in the past week and a half as interest rates went up, as the US dollar went up. So it's kind of one big trade. So when the market is like this, just kind of make sure when the market is trending for a few days, just to make as much as you can, and then the rest of the time just sit and watch.
5%, 6 month, 9 month interest in your savings account. Robinhood's paying 4.11%. Sometimes it's better to focus on your career, and 4% is better than losing your time. And you definitely need to stay in market if you're young, but indexing right here versus picking stocks is going to be tough. This is the one that I've talked about for a few weeks, but it's not going to hold Interactive if it.
Oh yeah, for sure. I mean, they're also paying, since they use them, they do pay 4% on used cash.
Yeah,
and
any of the brokers
basically use it as a bank account because it comes with a debit card. Which
absolutely.
No,
Vanguard has like a 4% money market, daily money market too. People don't be lazy. You can go get your 4%. Right now, if you're getting 0 and you're being lazy, go get that 4% and focus on your career and finding mentors and getting educated here. But right now, the biggest news of the weekend is Warren Buffett just yelling at people saying buybacks are good. It's in his interest to say that because that's what most of his companies do because they're not growing. Coca-Cola, Apple, but that's fine.
I read that a little bit of that annual report. He was mentioning that they invested whatever 1.3 billion in Coca-Cola and American Express in 1994, and they achieved such and such results. And I kind of compared to the S&P 500, and it's basically about the return of the S&P 500 or less.
Well, Amex probably has done better than Coke, but
just a little bit better, but not that much better if you consider the dividend.
AXP is
AXP, exactly. Because
if you count 08, maybe not. Oof.
I mean, I think I looked at them.
They had about 20 years ago and sideways. Got it. It's one to watch here too, as it kind of looked like strong, and now there's just nothing to get super excited. I know Cramer, everybody's making fun. Cramer was saying it's a new bull market. Listen, I don't know. I think it's just a tough market, is what it is. And VIX is at 20. I don't see an edge. I just don't see.
The entire January rally was based on the premise that the Fed is almost done raising and is going to pivot at some point before year end. And as the new data keeps coming in, all the inflation data that came out, just a little bit above expectations, this doesn't seem to be the case.
And they're banging the drum here, China now, Wuhan again, kind of. When things get boring, the government's just bringing up the China battle. Boy, China gave up a lot of gains pretty quickly too. The people that chase that China move.
Pretty significant pullback.
I know Baba's back below 90.
Baba, definitely big pullback. All of them, they kind of look the same. That's why I say correlations are so high that it's everything is one big trade right now. It's all about interest rates.
The only thing that's not a big trade is interest rates. They just stated 6 month, 1 year money markets. And money market's 4 to 5%. Like that's you farting around with the S&P, you're still ahead and just earning cash this year.
Most companies don't yield that, and then I think the yield on treasury is not even taxable; it's tax free. So it's kind of hard in a environment like this, really, for the S&P to compare.
You got to get me really excited to move major money into the stock market. I am seeing. Prices come down at seed. We're writing checks. We're being creative, but people just need to be patient. There will be some clearer signs. There were some nice signs in January, but rates are kind of controlling where we are right now. All right, buddy. I don't want to beat a drum. Everybody have a great week. Thanks for doing this.
All right. See you next week.